You've seen it, right? On pretty much every bill you get, from your coffee to your new phone. Those three little letters, GST. But what do they actually mean? Where does that money really go? Well, today, we're going to pull back the curtain and make GST super simple to understand.
So let's just jump right in, shall we? You see that word GST on your bill. Sometimes it's 5%, sometimes it's 18%. But what is it? And why on earth does it come with this whole alphabet soup of CGST, SGST, and IGST? Don't worry, we are about to clear all of that up.
So, here's the game plan for our deep dive. We're going to start with the absolute basics. What even is a tax? Then we'll get into IGST was such a big deal when it launched. We'll decode all those confusing acronyms, uncover the magic of something called ITC, see how this all affects small businesses, and then wrap it all up with a quick cheat sheet so you remember everything.
All right, first things first. What is tax anyway? We're starting right at square one, because before we can really get what GST is, you gotta understand the two main ways the government collects tax. It's a really simple difference, but it is absolutely crucial. Okay, so on one side, you've got direct tax. This is the tax you pay straight from your own pocket, on the money you earn, like income tax. You can't pass that burden onto someone else. But then you have indirect tax. This one's different. It's a tax on stuff you buy, goods and services, and you pay it indirectly as part of the price. And that is exactly where GST lives. The seller collects it from you, the final customer, and then they pass it on to the government.
So now we know GST is an indirect tax. But why was it even created? Believe me, it wasn't just some random idea. It was designed to be the hero that came in to fix a really messy problem with the old tax system.
Before GST, things were, well, a total mess. Seriously, imagine every single state having its own tax rules and rates. You had VAT, you had service tax, excise duty, so many different taxes. But the biggest, absolute nightmare was something called the cascading effect. This basically meant you were paying tax on top of a tax. A manufacturer paid tax, then the wholesaler paid tax on that new price, then the retailer did the same. By the time you bought the item, its price was bloated with taxes on top of taxes.
And then, on July 1st, 2017, GST swooped in to clean up this entire mess. It just wiped away all those different taxes and replaced them with one single unified system. The whole idea was captured in that one powerful slogan, "One Nation, One Tax." The goal was to finally have a system that was organized, transparent, and fair for everyone involved. Okay, wait a minute. If it's one nation, one tax, then why in the world do we see CGST, SGST, and IGST on our bills? I know it seems confusing, but the logic behind it is actually surprisingly simple. It all comes down to one single question. Where is the transaction taking place?
The whole secret is understanding these two terms. First, if the seller and the buyer are in the very same state, say someone in Mumbai sells to someone in Pune, that's called an intrastate supply. But if the goods cross a state border, say from Maharashtra to Gujarat, that's an intrastate supply. Seriously, once you get this, everything else falls into place.
And boom, this table right here makes it all crystal clear. Look, for a sale within a state, the GST gets split right down the middle. Half goes to the central government as CGST, and the other half goes to the state government as SGST. So, if the total GST is 18%, it's actually 9% CGST plus 9% SGST. Simple, right? But for a sale that goes across states, just one single tax is charged, IGST. The central government collects it all and then shares it with the state where the goods ended up. That's it. All right. Now we're getting to the really cool part, the absolute game changer of the whole GST system. It's called Input Tax Credit, or ITC for short. You can think of this as GST's superpower. It's the secret weapon that finally killed that awful tax-on-tax problem we talked about earlier. Let's walk through this with a super simple example. Let's say you're a trader. You buy some goods for 10,000 rupees, and you pay 1,800 rupees in GST on top of that. That 1,800 is your input tax. Now, you're going to sell those goods for 15,000 rupees, and you collect 2,700 in GST from your customer. That's your output tax. So, do you owe the government the full 2,700? No way. This is where the magic of ITC comes in. You get to claim a credit for the 1,800 you already paid. So you only pay the government the difference, 2,700 minus 1,800, which is just 900 rupees. That's ITC.
So, here's the big aha moment. The most important thing to remember is this. With ITC, businesses only pay tax on the value they add. In our example, the trader added 5,000 rupees of value to the goods, and the tax they paid was 900 rupees, which, hey, is exactly 18% of 5,000. It makes sure that the same item doesn't get taxed over and over and over again.
Okay, that's the theory. But what about the real world? What about small businesses like that little shop on the corner? Does every single one of them have to deal with all this? Let's look at the rules for them, including a special, simpler option they have.
So, does every business need to register for GST? Nope, not at all. It only becomes mandatory once a business's total sales for the year cross a certain limit, which the government sets. It's also a must if you sell to customers in other states or if you sell your products online through platforms like Amazon or Flipkart. Now, for smaller businesses that qualify, there's a much easier path called the composition scheme. Instead of dealing with all the detailed paperwork every month, they can just pay a small, fixed percentage of their total sales as tax. The upside? Way less hassle. But, and this is a big but, they can't collect GST from their customers, and they can't claim that magical input tax credit. It's a trade-off: simplicity versus the financial benefits of ITC.
All right, we have covered a ton of ground, so let's do a super quick 30-second recap to make sure it all sticks. This is your go-to GST cheat sheet. Ready?
Rule number 1. If a sale happens locally, all within one state, the tax gets split right down the middle. Half for the center, CGST, and half for the state, SGST.
Rule number 2. If that sale crosses a state line, it's even simpler. One single tax, IGST, is charged to keep everything clean and straightforward.
And finally, the most important one to remember, the superpower of the whole system, ITC. Input tax credit is what makes sure you never, ever pay a tax on top of a tax.
So, the next time you look at a bill, you won't just see some random letters and numbers, you'll actually see the whole system at work. You'll understand how that money is flowing from your wallet to both your state and the country. GST might seem complicated on the surface, but now you know the simple logic that makes it all tick. Stay smart and stay informed.